Good morning. My name is Laura Christian Imbernoni, and I want to thank you for coming today and welcome you to our forum. Our speaker will discuss current inflation issues. We know how important a topic that is right now, especially with inflation having multiple impacts on our lives and communities. Prices have increased, and supplies of various commodities have not always been stable. COVID has played a real factor in our everyday shopping experience as well. We wonder what the future will hold for our economy. Our Shaker Heights Unitarian congregation organizes forums on important topics like this one as a congregational service to the community and to support personal reflection, social action, and encourage individual and collective growth for all of us. We really appreciate your participation. Now, I'd like to introduce the coordinator for today's forum, Dr. Wayne Jennings, an analytical research scientist at NASA Glenn Research Center. He'll introduce the topic and our speaker. Wayne.
Good morning, everyone. As a member of our Unitarian Forum Committee, I'm pleased to introduce our forum this morning. Our discussion today will address some of the ways in which the economy impacts our lives and communities. The Federal Reserve Bank here in Cleveland conducts applied research and analysis in a number of areas. They focus their economic lens on workforce development, small business concerns, access to credit, inflation, along with other issues. Our main topic today is inflation, so our speaker will be concentrating his remarks on what it is not, and other related issues. I'd now like to introduce Dr. Robert Rich. He is the director of the Center for Inflation Research at the Federal Reserve Bank of Cleveland. He's also a senior economic and policy advisor there. Before joining the Cleveland Bank in 2018, he was an assistant vice president in the research department at the Federal Reserve Bank of New York. He's published articles on a variety of economic topics and has taught economics at Vanderbilt University. Before I turn this discussion over to you, Dr. Rich, I have a few brief housekeeping items. I want everyone to know that we'll open the discussion to questions and answers at around 10 o'clock. And if you have a question or comment while you're listening to Dr. Rich, please use the Q&A button on your screen and type in your questions. I'll now turn this discussion over to you, Robert. We welcome your comments this morning. Thank you.
Thank you, Wayne. Good morning, everybody. Let me begin by bringing up my presentation, hopefully successfully. Are we good as far as the presentation? All right, good.
Yes, looks good.
Very good, thank you. Good morning, everybody. Thank you for this opportunity to speak to you this morning on the topic of inflation. Let me begin by noting that the usual disclaimer applies, and I'm going to read this, which is that the views expressed herein are solely my own and do not necessarily reflect the official views of the Federal Reserve Bank of Cleveland or the Federal Reserve System. So for today's presentation, I've divided it up into three parts. The first part is simply, what is inflation? I think this is a term that everyone sort of thinks they're familiar with, but it can be somewhat misused. So I think it's worthwhile to review exactly what we mean when we talk about inflation. I'll also talk about how we measure inflation, in particular, two price indices that you probably have heard of, the Consumer Price Index, and then the Personal Consumption Expenditures, or PCE price index, and then get to probably what is the topic of utmost concern and interest, which is inflation during the pandemic, and in particular, what accounts for the fact that we've seen these elevated readings of inflation recently. So before I begin, I think there's a couple very important background points that I would like to make out. I think, first of all, it's important to recognize that in a market economy, like in the US and most other major economies, it's important to understand that we need to have prices changing and moving. And in fact, this is the way that resources are allocated in the economy. So the fact that prices are changing actually is in fact important for how a market economy is going to work. So prices moving actually are very important. Not only do prices tend to move over time, they also tend to move relative to each other. And these relative price changes, how the price of one item, good or service may change relative to another, sort of reflect underlying supply and demand conditions. And those relative price changes is how essentially in a market economy, it acts as a signal for shortages and surpluses. And that's what is used then to sort of direct resources either away from places where there are surpluses and towards places where there are shortages. And this is how consumers and firms sort of respond to these changing market conditions. So just as a background starting point, movements in prices provide very, very important information. I think that's worth remembering as we think about the topic of inflation. So with that, let me begin by actually providing a definition of inflation. And I think there are two very important takeaways in terms of this. So a very conventional definition of inflation is a sustained increase in the general price level of goods and services in an economy over time. And so the two very important points to take away from this is that the following. Inflation should not be associated with the price of a single item moving higher. So while we may see food prices moving higher, we may see energy prices moving higher, we should not think of inflation as being associated just with the price of a single item moving higher. Rather, inflation should really be associated with the prices of many items moving higher and continue to rise. So it's the ideas we'll see of sort of prices across goods and services, those prices sort of moving together, moving higher and continuing to rise on a sustained basis. And that's what we mean when we talk about inflation. So again, moving away from the idea that it's associated with a single item, rather a collective groups of goods and services, their prices moving higher and continuing to rise. That's what we mean by inflation. So then how do we measure inflation? And again, this is probably something that most people are familiar with. The government has statistical agencies. They go out and gather information on the prices of goods and services, and then they combine these into what's called a price index that reports the cost of buying a market basket for a relevant group. So I've sort of showed a picture here of what we would think of as a market basket, literally. What I do, however, want to emphasize, and I'll get back to this, is that while you see the items in here, you should think about the fact that this market basket, especially for consumers, includes not only goods, but also services. So I couldn't quite put pictures of services in that basket, but I'll talk about this a little bit more. But again, you can think about essentially putting them together. You have some market basket of goods and services, and then you're essentially you're combining those prices into a price index. Now, there are many different price indexes. So there are prices for items bought by households. And as I will say, like the CPI and the PCE price index are measures for sort of the price index for consumers, but there are also prices of items bought by firms. So we have price indices for firms. We also have prices for goods or services. And I'm going to come back to this point. This is actually going to be critical for understanding what the current inflation situation happens to be. So understand that we can construct a price index that focuses on a market basket of goods. We can also construct a price index for a market basket of services. So when I mean goods, for example, I'm talking about things like, say, new cars, used cars, apparel, furniture, electronics. When I'm talking about services, I'm talking about things like shelter, airfares, hotel prices. And separating out between sort of goods and services, as you're going to see shortly in this presentation, is critical for understanding what's going on with inflation today. And also then again, other sort of price indices, we have prices for imports or exports. So again, a variety of price indices, although some will be more relevant for, say, if you're a household or consumer. So then how do we actually measure inflation? So a price index is not a measure of inflation. Rather, inflation is measured as a growth or a percentage change in a price index over a particular time period of interest. So you can talk about inflation on a monthly basis. You can talk about inflation on a quarterly basis. You can talk about inflation on an annual basis. There are lots of ways to measure it. But again, measuring inflation, you're talking about a percentage change or a growth rate in a price index. So let me just turn to the two probably most widely known price indices, and these are for households. And the two primary price indices are the Consumer Price Index that's produced by the Bureau of Labor Statistics and then the personal consumption expenditures, or PCE price index, which is produced by the Bureau of Economic Analysis. Both of these price indices are essentially intended to measure the cost of spending on goods and services by households. So these are measures of inflation rates for households. Now, it does turn out that there are differences between them, although in general, as you'll see shortly in the next picture, they tend to give a very similar reading. But the point is that they're both intended to measure essentially the inflation rate faced by households. And then again, while there are some differences between them, and I don't want to spend a lot of time discussing what those differences are, generally, as you'll see, they're going to give a very similar picture and paint a very similar picture of what inflation to households happens to be. And again, when we now talk about CPI inflation or PCE price inflation, again, think of that as being calculated as a growth rate or a percentage change in that price index over 2 time periods of particular interest. Okay, so here's our first picture that I want to show to you. And I think what I'd like you to take away from this are a couple points here. And hopefully you'll be able to see my cursor as I move it. The first point is you'll see that in general, CPI and PCE inflation, and here I'm doing a 12-month percentage change. What that basically means is I'm calculating inflation from, say, January in one particular year relative to January in the subsequent year. So that's the 12-month percentage change. Notice how these two, the blue and the red lines, tend to move together, and they're generally giving us a very, very similar picture in terms of what's going on with the current inflation rate. I've plotted this starting in the mid-60s to sort of talk about various episodes associated with inflation. So as you can see, we can see the rise of inflation sort of towards the end of the 60s. And then what we can see then is the high inflation decade of the 70s, where we sort of the first OPEC oil shock and food price shocks in 1973. And then again, the high inflation episode continued towards the late 1970s. And then you can see this rather dramatic decline taking place in inflation that was associated with the Volcker disinflation. And then as we move through the 90s, what you can see is this rather remarkable stabilization of inflation, where suddenly inflation began to sort of stabilize, really wasn't particularly volatile. And in fact, when we entered into the most recent decade, the decade of sort of from 2009 onward, you can see that inflation sort of ended up being in this very, very low inflation. Inflation was quite stable and low. But then at the very end, and let me just move this. Now what I'd like to focus on is this recent rather dramatic rise that's taken place in inflation, where we now see CPI and PCE inflation rates on a 12-month basis in excess of 5%. And this is obviously what the topic of today is going to sort of focus on, which is what happened? Why are we now experiencing these very high elevated readings of inflation? So the next 6 slides, I hope, are going to be the answer to the question of why, in fact, we're seeing the high inflation rates. So I want to talk about inflation during the pandemic, and I'm going to have reading points and graphs. So as I say here, the pandemic has been a central force impacting the behavior of inflation during the past 2 years. Now, at the beginning of the pandemic, we saw this marked slowdown in inflation. Okay, however, starting about a year ago, we saw this surge take place in inflation. And so the key point I would like to make, and the point that I'll come back to in terms of what's going on recently, is the next point. A critical factor explaining why inflation has risen and why we're seeing elevated readings of inflation is because from consumers, there has been a dramatic shift in the composition of spending away from services and towards goods. And this isn't surprising because of the nature of the pandemic and what happened. Remember, at the beginning of the pandemic, there were lockdowns and social distancing measures. That had a very strong effect in terms of diminishing spending on services. There were simply services that were not available because of lockdowns and social distancing. And because of that, we saw consumers then rotate or shift away from services spending into goods spending. And again, this will be shown by the next picture. What I want to then now focus on is exactly this rotation I was talking about. And what I've plotted for you here is trillions of chain 2012 dollars. Essentially, this is real spending on services and goods. And what you can see is prior to the pandemic, services and spending is much higher than goods spending. But when the pandemic took place, we saw both services spending and goods spending decline initially. But what has happened subsequently is, while we have seen somewhat of a recovery of services spending, services spending still has not gone back to pre-pandemic levels. And in fact, if you think about the trend that's here, you can actually see that we still haven't even gone back in terms of spending on services to where we were at the beginning of the pandemic. On the other hand, notice what's happened with goods spending. It declined, but again, because of the fact that you really couldn't spend on services, there was a rotation into goods spending. Notice how much goods spending has risen. And again, relative to the trend where it might have been, you can see how much higher goods spending has been. So this is that rotation, again, from consumer spending away from services into goods. So that's probably one of the first and most important points to understand is this rotation that's taken place in terms of consumer spending. So what can we say now about the current inflation environment? The recent surge in inflation reflects an imbalance between demand and supply. First is to note that demand in the economy continues to grow at a very robust pace. And the reason for this is, remember, think about the fiscal policies and the monetary policy support that was put in place to support the economy at the very beginning of the pandemic. We wanted to avoid a situation where the economy was potentially going to fall back into a very severe recession, or maybe at the time that it was discussed, a second, Great Depression. So we put in very generous fiscal support, and there was very accommodative monetary policy to maintain demand and to keep demand very strong. As a consequence of that, we now see that on the demand side of the economy, we still are seeing a lot of pent-up demand and excess savings on the part of households that's translating into spending. So we have very, very strong aggregate demand that is continuing to take place. Now, the next important point to make then is what's happened on the supply side. I'm sure we're all aware of the fact that we have bottlenecks and supply chain disruptions taking place, but that's taking place in the goods sector. The goods sector is the sector where these bottlenecks and supply chain disruptions are really impacting. And so now, as we'll see shortly in a picture, think about what I've just described. Demand is staying very, very strong. You've had a rotation out of services into goods, but now what you're seeing are bottlenecks and supply chain disruptions in the goods sector. And as a consequence of that, the pickup inflation that we have seen is largely the result of increased goods prices. And while services price gains have been muted and rising, and wages have largely been secondary so far, it is principally goods prices that is driving the high elevated readings of inflation. And so I hope the next picture with all of this as background is going to really bring home this point. What I've done here is shown exactly CPI inflation, and I've now broken it down into goods versus services prices. And what you can see now is, notice the red line, which is CPI inflation. Notice this rather dramatic rise that has taken place. While it's true that we've seen some rise in services inflation, the blue line going in line with that, notice the dramatic rise that has taken place in goods CPI inflation. And it is in fact this rather dramatic increase in the inflation rate of goods prices that is largely responsible for this rise in the red line or CPI inflation. What's even more remarkable is compare the recent behavior of goods inflation here with where it had previously been in the prior decade. It was not unusual for overall goods to actually be negative, meaning that we were witnessing declines in the prices. And so we've had this rather remarkable increase in goods inflation, shown by this orange line, which is then in fact pulled up the red line. And this is what's principally responsible for what's going on. And so again, let me just go back to the narrative that I previously had to explain what's been going on. We still see very, very strong demand in the economy. We see a rotation out of services into goods, and then we see supply constraints taking place from supply chain issues and bottlenecks, all of which has resulted in a very dramatic rise in goods inflation, which is the principal factor that's been driving up CPI inflation. Okay, so I'm trying to see what time it is. Bear with me just for 1 second as I try to get a better read. Okay, looks like I have a little bit of time. So these high inflation readings were initially driven by a limited number of items, but are now more broad-based. And this is what we're experiencing right now. And elevated inflation readings are also lasting longer than expected. So we had expected that these high inflation readings were going to sort of dissipate. You may have heard discussions about how we were anticipating temporary inflation, or how the transitory inflation that was taking place with these high readings. What's actually taking place now is we're now seeing that these price increases are now sort of a more broad-based than they were previously. A lot of it initially was driven by things like new car prices and used car prices. But now we're seeing that the inflation readings are now more broad-based than before, and they're also lasting longer than they were before. This has then brought about a number of questions, and in fact, two questions that have been that have received considerable attention is, what has this high inflation meant in terms of going forward? Are we going to potentially see a return to the 1970s? You may have also heard some discussions about the onset of a wage price spiral. So let me talk about both of these questions, and then also note that what's really critical for thinking about a return to the 1970s and the onset of a wage price spiral is the impact played by long-run inflation expectations, which is something that the Federal Reserve is going to monitor. So let me begin by saying why I don't think we're going to see a return to the 1970s. And in fact, I think that what Chair Powell has said and the inflation outlook going forward is that we anticipate inflation is going to moderate towards the middle part of this year or towards the end of this year. And what are the reasons why we think inflation is going to moderate? Okay, we think inflation is going to moderate because, first of all, fiscal support is not going to be as strong as it previously was. You've probably also heard, too, that the Federal Reserve is going to begin to start raising interest rates. So both of those should help slow down the pace of increase in aggregate demand. We also anticipate that some of the bottlenecks and supply chain disruptions are going to go away towards, or at least improve in the latter part of this year. So a combination of slowing the increase in demand along with an increase in supply should help moderate inflation and be responsible for seeing inflation moving down from its current high readings. Going back to this question about a return to the 1970s, the onset of a wage price spiral, what's really important to understand is that that inflation expectations are critical for whether or not we're going to see inflation continuing to rise on a sustained basis. And the reason for that, as we'll see in a slide, is the following. Expectations influence behavior. And when we have higher inflation expectations, if inflation expectations start moving up, we can see that then potentially generating ongoing and sustained increases in prices. A return to the 1970s? No, I don't think that's going to take place. The number of reasons why are, first of all, I think that we learned a valuable lesson from the 1970s about what happens when we don't monitor inflation expectations. I think it's also important to understand, too, that the Federal Reserve now understands and is much more open about communicating to the public about the policies that they're going to implement. Some of you may remember in the 1970s, there was a book called Secrets of the Temple. It was the whole idea that the Federal Reserve tended to be very cloaked and quiet about what it's going to do. That's not what we do. We recognize that there is a benefit to communicating to financial markets and individuals to let them know what we're planning on doing. Also, the US economy structurally now is very different from what it was in the 1970s. There was much stronger labor unions in the 1970s. There were also cost of living adjustments. All of those sort of helped to sustain high inflation readings. And certainly labor unions and COLA clauses are just not as prevalent as they were. The onset of a wage price spiral, this is the idea that as prices rise, you see wages rising, which leads to a subsequent rise in prices and a subsequent rise in wages and this ongoing spiral. The reason why, again, I don't think that's going to take place is because, again, we now understand and can monitor inflation expectations. If we begin to see longer run inflation expectations, which so far have been rather stable, if we see them starting to rise, that will be something that will cause us to take even greater policy action. And so the more that we can maintain long run inflation expectations and keep them stable, the less likely we're going to see either a return to the 1970s or the onset of a wage price spiral. So this is going to be my second to last slide. I have about 5 minutes. Why are inflation expectations important? Because economic decisions not only depend on past and current events, but on what is expected in the future. And so if people begin to expect higher inflation, they will undertake actions that in fact can cause higher inflation. But we at the Federal Reserve have understood and now recognize that it's very important to monitor long-run inflation expectations. The reason for that is because longer-run inflation expectations are important for the setting of wage and price contracts. They're important for the borrowing and lending decisions. And so as we look at the inflation outlook and as we think about whether inflation is going to moderate or not, it is critical, and we will be paying particular attention to inflation expectations, and in particular long-run inflation expectations. As long as they may remain relatively stable, that will be a sign that in fact we anticipate that the moderation in inflation that we're expecting will take place. Having said that, I should also mention that while we expect inflation to moderate over this year, there's considerable uncertainty associated with that forecast. Omicron is still sort of its effects, and the COVID-19 virus is still very unpredictable. How it may impact the economy, again, makes our forecasts of inflation somewhat challenging at this point. There are geopolitical issues that are going on. There's the policy that China has adopted with the zero sort of lockdown policy. So all of these factors are going to potentially impact where inflation is going to be and give rise to a great deal of uncertainty. But as I would say, and before I go to my final slide, our viewpoint, the same viewpoint that's been expressed by Chair Powell, is we do expect inflation to moderate towards the latter part of this year. Again, fiscal policy will not be as strong as it was. Monetary policy will be less accommodative as we begin to raise the federal funds rate. And we do anticipate that some of the supply chain disruptions and the bottlenecks will begin to sort of dissipate and improve. So for my final slide, and to conclude, I think I want to do a little advertisement for you. I'm with the Center for Inflation Research, which is the Federal Reserve, at the Federal Reserve Bank of Cleveland. We launched this in December of 2018. And what I want to emphasize to you is that we actually have a website. And we have a website, and in that website, we have a number of sort of blocks you can go to, but there's one called Inflation 101, which I hope you'll visit. It has a lot of material and resources on inflation, explaining inflation concepts. It's got some animated videos explaining what is inflation, how inflation affects you, why you should care about inflation, why the Federal Reserve cares about inflation. It's a resource that we have that's there to sort of educate the public, policymakers, and researchers. Again, if you simply type in Center for Inflation Research, it will take you to the website. We have it there. We have some of our research that's there. We have data offerings. But again, I think if you were to go to a section called Inflation 101, I think you will find it very informative. It also has some answers to some questions that have been raised about the current inflation environment. And so with that, I think I will conclude and say that with that, I will go ahead and look forward to answering any of your questions. So thank you for your opportunity to speak with you this morning. Thanks.
Thank you, Robert, for an excellent presentation. I know I speak for the audience when I say we all learned some valuable information about inflation and its impact on our community. It's now time for questions and answers. Please look for the Q&A button on your screen and type in your questions or comments. I will now turn this over to Debbie Wright and Cliff Wire, members of our forum committee and co-chairs of our Q&A session. They will choose the questions or comments you've typed in the Q&A button and relay them to Dr. Rich. If your question is chosen, they will recognize you by your first name unless you hit the anonymous button. So Debbie and Cliff, take it away.
Thank you for your great presentation. My first question is actually about wages, and specifically effective wages, because we've seen such a large increase of wages in lower wage sector, and that's going to result in higher services. And on the other hand, to offset the higher services, I hear that it's going to increase automation. We also have the loss of new immigrant workers with the new visa systems that we have. So how is that going to affect all this? I know this is really like a micro part of the whole bigger picture, but.
Okay, so those were all great questions. So let me begin to answer the ones that I can remember, and if there are parts of it that I failed to bring up, please remind me about that. So one of the questions then is we've seen some rather strong increases in wages taking place. What does that portend? How do we think about that? So I think I'll answer that by first of all noting that wages are in some sense a price. Wages are the price of labor. When we see wages going up, I think that is simply an indication right now of how strong the labor market happens to be. And I think it also is indicative of another way that you think about allocating resources from certain sectors into other sectors. So we are seeing very strong wage growth. I think part of that is just a reflection of the fact that we have a very strong labor market. I think it also just points out that we have just very, very strong demand in the labor market. And as people are probably aware, we've actually seen somewhat of a cutback in the supply of labor during the pandemic for a variety of reasons. I mean, some of this is because people are worried about obtaining COVID, some because of childcare and caregiving responsibilities. And so that combination has led to a rise in wages. Is it then that we should immediately think of those wage increases as necessarily translating into price increases? And here I want to sort of say we need to be a little careful about that direct linkage that I think many people would expect to take place. In the short term, if firms are faced by higher wages, and depending upon the amount of market power that they have, firms do not necessarily have to meet an increase in wages with higher prices. You also have to think about productivity. If firms are becoming more productive right now relative to where they were, they can absorb wage increases without necessarily having to pass them in higher prices. So if firms are becoming more productive, that will act as an offset to sort of wage pressures. Firms can also, in the short run, absorb some of those wage increases in a lower profit margin. So rather than by raising prices, they're going to simply have to accept somewhat of a lower profit margin. Having said that, though, it is certainly true that in the current environment, and certainly depending on the extent of market power that some firms have, you may see some increase in wages being passed on into prices. However, the critical thing to think about then is that cycle going to continue? In other words, is this increase in wages that we're going to see sort of a one-time event where we're then going to see sort of prices going up? The critical factor then is, are we going to continue to see this sort of ongoing process of feedback between them? And that's where, again, I think that you have to be very careful and not extrapolate that this is going to be an ongoing sort of process that's going to take place. So yes, we are seeing higher wages. Again, part of that is simply a reflection of labor being allocated among different sectors. We may see some of that being passed through into higher wages. For example, in the restaurant sector, we are seeing some evidence to suggest that there is some pass-through taking place. But in general, the narrative that says wage increases are immediately going to move into higher prices, that doesn't necessarily work as easily as we think it might. As far as the question about automation, yes, there is, in fact, I think we are seeing some firms thinking about adopting capital investment to sort of replace labor and to substitute capital for labor. I think another thing that's important to think about too, and on a longer term basis, I think, is that we're also seeing now firms rethinking of the whole supply chain issue. You may have heard mention about reshoring. Are we going to see sort of firms now moving away from offshoring items and bringing them back domestically because of supply chain disruptions? I mean, that's another critical factor. There are some discussions among firms that they're going to be thinking about doing this. So the impact on labor right now is very important. There are implications for sort of the short run. There are also longer running implications that will be taking place. And so I hope that gives some answer to the question that was being posed.
Hello, do you have a question?
Yes. Ken here has a question. Media indicates that retirees, oftentimes on fixed income, experience a greater impact of inflation. It just went away.
Oh, I'm sorry, I did. That was my fault. Oh, I'm sorry.
Okay, inflation than other consumers. In part, retirees experience eroded savings, higher cost of food, higher cost of heating and healthcare. Do you have a comment regarding this segment of the consumer market?
Yes. So those are excellent points. And yes, when one thinks about the costs of inflation, there in fact are not borne equally across groups, socioeconomic groups. Inflation, and especially higher inflation, certainly has a stronger impact on people that have fixed income, simply because of the fact that their income is not going to be able to go as far as it was previously. Another thing that's actually quite interesting too is that there also is this idea of, and along the same lines, that there are somewhat examples of what's called inflation inequality. There are socioeconomic groups that are more severely impacted by higher inflation than others. And in fact, lower income individuals and groups tend to be more severely impacted by inflation because of what they buy and because they're more limited in terms of their ability to sort of get better prices for the items that they're purchasing. So it typically turns out that individuals that tend to be in lower income groups tend to be more adversely impacted by inflation than individuals in higher income groups. And certainly within, the segment of society, people on fixed incomes certainly have a much tougher time and are impacted much more by inflation. So yes, those points are quite true. And again, when we talk about inflation, we sort of talk about it without recognizing that there's a lot of diversity within the economy and there are a lot of different groups that are going to be impacted. So this idea of inflation inequality, and certainly retirees and certain groups, they're going to be much more severely impacted by inflation.
This is a question from Susan. In your opinion, will the dollar continue to be the world's main reserve currency? When governments face stress, they need dollars, and they allow us to continue to borrow more than any other country. In your opinion, can China or Russia borrow money in any way commensurate with the United States? Are Russia and China's currencies gaining stability and trust?
So I have to be honest and say that this is a little bit outside of my area. And I think also the nature of the question is one that's probably one where I would prefer to maybe not get myself in any more trouble than I've already gotten myself into. I think what I'll do for the moment maybe is just suggest that, the situation with the dollar will be dictated by a variety of factors. I mean, again, we know that in times of crisis, we know that there tends to be capital flows and flights to dollars. We also understand too that the movements of the dollar will depend upon a variety of factors. So I think I'll just sort of, if it's all right, just defer the answer to that question for the moment.
Absolutely fine. You don't have to do anything controversial. I'll ask you something that I just kind of wonder about. It's things like education are important for making a living, making your way in the world. Daycare is necessary for women to be in the workforce. The relative cost of daycare and education today is so much higher than it was when I was that age. So when I was that age, I could afford daycare for my child and still bring home some money. I know women now, with the increased costs of daycare, with increased cost of college, you can't afford it in the same way. My husband could pay with some minor loans and a part-time job his college tuition. You can't do that anymore. I mean, those are issues that the current market forces need. Maybe we need to go beyond market forces to help that situation.
So let me begin by saying that in the context of monetary policy isn't in a position to affect that. I think that my answer to that question would be that's very much an issue that should be dealt with, or should be dealt with more at the fiscal level in terms of how you want to think about enacting programs, whether you want to think about subsidies, how you want to then potentially deal with those types of issues. Those are not issues that, say, the Federal Reserve itself, that doesn't really fall within sort of where we undertake policy and things like that. But I certainly recognize that those are important issues. I certainly recognize that those are critical for the well-being within the economy. But those types of issues are those that I think the fiscal authorities, whether it's local or state or even federal, those are the ones that have to think about enacting policies in terms of where you want to think about, how you want to think about impacting policies that are going to change that, whether you're going to think about various types of loan programs to students, where you're going to devote more resources to expanding education. But again, I think that's very much outside the realm of monetary policy.
I understand that, but if they don't address that, how is it going to affect our inflation and our economy in the long run?
Well, sure. I mean, I think the first reaction I would have clearly is we think of education as being very critical for expanding the skill set of workers and enhancing their productivity. So I think that the more educated that you happen to have of a workforce, that you're typically going to have a more productive workforce. A more productive workforce will then be paid more, but also by being more productive can also act to sort of restrain price pressure. So, enhanced productivity also tends to allow the economy to grow faster without actually generating higher inflationary pressure. So I think of that as an investment in sort of human capital, trying to improve your workforce. And the skill level associated with that. Then there's just all the additional questions of how those skills can then, sort of allow for business formation, things along those particular lines. So yes, it's obviously very critical for the quality of your workforce. I would say that, it certainly would show up immediately by the fact that a more productive workforce, there's a number of importance factors associated with that. I mean, productivity is how we increase the standard of living, and other things along those particular lines.
Cliff?
Biden's 7% inflation in 2021, not his recent jobs boom, has mostly dominated recent news coverage. What is your assessment of how well or how poorly reporters generally cover economic news? Do the national media journalists dig deep enough to really give a balanced perspective on what's happening with the economy, or do they give too much partisan coverage?
Okay, wow. All right. So let's, I'm going to take a deep breath. I don't want to comment directly on, so media coverage, I think how the media covers a particular topic is very much what the vested interest happens to be by the person that's covering it. Let me just try to, I think, highlight again, and I hope this came across, where and what is going on currently with the inflation environment. I think I'm trying to be very objective in terms of explaining why we have the high inflation readings, and which is to simply say to individuals, what we're seeing right now is in some sense not surprising if you think about the fact that we have very strong demand, a rotation of that demand into goods away from services, and then on top of that, supply constraint within the goods sector. So I hope that if there's one message that came out today, I hope it was trying to have people gain a better appreciation and understanding of why we're seeing the particular higher inflation readings that we are in some sense, and what's responsible for that. I don't want to comment directly on, a particular political party. What I will say, though, again, and I think this is important, and this is clearly my own opinion, I think what's important to say is, think about where things were almost 2 years ago, right? When the pandemic just first came on. There were a lot of unknown unknowns. We had never faced anything like this before. I think there was a recognition that this potentially could be very severe. I think if you remember 2 years ago, there was a widespread concern about the fact that we weren't just going to have a recession, but we could in fact potentially have a second depression. And again, I understand from 2 years ago, it's hard enough for me to keep remembering things from yesterday, but to think about 2 years ago. I think what has been remarkable, and Chair Powell talked about this in his recent press conference, is the response in the US, as well as in other major economies, to the development of COVID in terms of fiscal and monetary policy to try to shore up the economy, to ensure that we didn't have a collapse. I mean, the US economy essentially shut down for 3 months, which, if you think about it, is just unprecedented. So what was put in place back in, sort of 2020, it was remarkable both in terms of how rapidly it was employed, but also the magnitude by which it was employed. And we did avoid, a second depression. I mean, we did manage to do that. Some of that support is still very much being seen today. Okay, and so I guess my point is how you want to read the current inflation readings and how you want to read things, I think should all be placed in the context of the events leading up to this. I mean, it was, again, a lot of support put into the economy in 2020. Again, there's a lot of pent-up demand. There's a lot of excess savings that were taking place. And again, because of the pandemic, expenditures on services just were not available. They had to go, people rotated into goods. We're seeing now, high inflation readings. We are seeing in some sense a broadening of inflation pressures than we did previously. It's not just limited to new car prices or used car prices or some of the items that were largely driving them back in the fall that were driving the high inflation readings. But again, asking where we think inflation is going to go in terms of the outlook, in terms of the forecast. I'm not saying anything different from what I think Chair Powell, members of the FOMC committee have said. We do anticipate that inflation is going to moderate towards the latter part of this year. Again, monetary policy will be less accommodative. Fiscal policy is not going to be as strong as it previously was. And we anticipate again, that sort of the bottlenecks and the supply chain disruptions, that those are going to improve. Those should all help to move inflation lower. And again, if we do in fact see evidence that inflation expectations start moving up, and a term that you may have heard is called an unanchoring of inflation expectations. That just is an indication that people are starting to build in higher inflation expectations, sort of into their minds. If we see those taking place, and that's a very important indicator that we're going to monitor, then additional policy actions may be taken to ensure that we don't see sort of the wage price spiral that people are concerned about, or the inflation of the 70s. So again, if my presentation today did anything, I hope it was to try to give an explanation for what we're seeing and the factors behind that, how the media wants to cover that, how they want to spin that. I will leave that up to the media. I'm sure that there are media outlets that have a particular perspective that they're trying to convey, and they will choose to cover it and spin it in their particular way. Hopefully today I provided more of an objective evaluation of what's going on with inflation.
Okay, I have a question from the audience here.
Hi, sorry, I came in a little bit late, but I appreciate what you've been saying. One of my questions was, how much does the President of the United States just in general really affect monetary policy throughout? I mean, obviously their agenda and stuff pushes a lot, but I also sometimes just wonder how much of what we're seeing would have happened regardless of who was in charge, just by the natural market forces and whatever.
Okay, I'm sorry, I just missed the very beginning. Were you asking about the president? I'm sorry.
Yeah. How much does the administration, the President of the United States truly impact the inflation and things like that? Sometimes I just get skeptical that maybe who's ever in charge would have the same issues and same responses to some extent.
Okay, so let me answer that question. I've a couple of different. Let me give you a couple of different answers, because I think there's a couple of things behind there. The first I just want to reassert, as you probably know, is the Federal Reserve is an independent entity. All right. So okay, very good. So we very much value being independent of the fiscal authority. And in fact, it's the whole idea that we are not going to be, in some sense, we're not going to kowtow to political pressures in terms of what we're going to do. We have a mandate that was provided to us from Congress for maximum employment and price stability. And those goals, while they were given to us by Congress, how we go about achieving those goals, we're very independent of what that's going to be. So the first thing I just want to reiterate is that the Federal Reserve is an independent entity from the political, from political pressure. And in fact, that's something that I think is very important for ensuring, that we're not going to end up with sort of any situation where sort of the Federal Reserve is responding to political pressure. So we have a mandate, and we're basically left alone to achieve those goals of maximum employment and price stability as best as we see it. The second part of the question was?
He's coming back.
Oh, okay.
But presidents do get judged on the economy, right?
Oh, no. So yes.
That's it precisely. Yeah. You've, when the economy does well, the president takes credit. When the economy does bad, people blame the president, the other party especially. And that's sometimes skeptical.
Right. So okay. So I believe that human nature is human nature. That if you know there how the economy is performing will clearly weigh on how voters are going to make their choices. And certainly if an economy is doing well, I don't think I would be considered to be out of bounds by saying that probably voters will have a very favorable view of an administration. If an economy is not doing well, then I think that it's clear that some voters may not have a very favorable impression. What I would hope, though, and again, this is just me speaking of my own, I would hope, though, that voters and individuals will look to see what the particular factors are for what's going on and the extent to which those can be controlled or not controlled by a particular administration. And again, I'm not trying to take sides here. I, again, tried very much today to provide an objective analysis of what we're seeing. How voters respond to that, whether voters want to hold a particular administration responsible, that's pretty much outside of what I or anyone else can do. I do again hope that I was able to get across where and why we're seeing the high inflation readings. I know I keep repeating myself, but I think it is something where ensuring that the discussion is factual as much as possible was one of my primary goals for today. And I hope I was able to do that.
Yeah, it's helpful. Yeah, I wish the media followed that advice too. Cliff, do you have a question?
Yeah, we got a question from Valerie. How does inflation normally affect performance of investments in stocks and bond funds?
So that's a finance question. I'm not really a finance person. There's a lot of research that I think has looked into this question about what investments do well in high inflation times. It's really a little bit outside of my scope in terms of thinking about the investment side of things. I mean, certainly during the 1970s, when you had extremely high and persistent inflation, there was a lot of investment in commodities. And that was, I think, the way that people thought about investing. You can also invest these days in sort of index funds that are TIPS, treasury, TIPS are sort of a way to do that. I'm not sure that the jury is out entirely in terms of how inflation impacts particular investments, because I think every inflation episode is quite different, and there are other factors that will be weighing on financial markets. So I don't think that there is a singular way of thinking about, inflation. If I see inflation, I should think about these investments. I mean, another question too is how long you think inflation is going to persist. I mean, again, we hopefully will just be going through sort of a blip right now in terms of the higher inflation readings. But again, I think the analysis in terms of how inflation impacts investments, it's much more of a finance type of question. And I wouldn't want to comment on that because I don't think that's something that I'm as informed about as perhaps some others might be.
Yeah, I appreciate that. We obviously don't know the difference between finances and this other stuff as a general public. But here's a question that's very specific. My son is trying to purchase a home in Colorado. If the Federal Reserve raises interest rates to slow inflation, isn't now a better time to buy a house than in the middle of June when interest rates will probably be higher? And I'm asking this when I paid 16% interest on my home, Yeah.
So I don't want to make a recommendation on this. I mean, obviously, mortgage rates are something that obviously will impact your decision on whether or not to buy a home. And certainly if interest rates and mortgage rates are going up, then that obviously will tend to sort of cause, your payments to go up relative to what they were before. How and when you want to decide to buy a home and where you want to live, I think is very much a function of sort of personal taste and attributes. But we would anticipate that higher interest rates are going to generally lead to higher mortgage rates. Again, what really is important in terms of thinking about a home, however, isn't just the interest rate you're paying, it's the real interest rate. That is the interest rate less whatever the inflation rate happens to be, what that real rate of interest happens to be. So good luck. Good luck purchasing the home. I believe that I would say one thing too. I mean, we are seeing shelter prices going up, and I think that one other aspect of the pandemic that I didn't touch on, but I think that people are quite familiar with, is there has been a rather dramatic shift in housing and the demand for housing because of the pandemic. And I think what we saw and have seen is sort of a very large price rise, which is what you'd expect, because we have seen, in fact, there was a limited supply of housing, and then we saw a very large demand for housing take place. People wanted bigger homes. People wanted to move out of sort of urban areas into more rural types of areas. We saw prices going up in housing, but that's very much the response that you would expect when you have like this shift that took place. And so another aspect of the pandemic that I didn't get into, though, is the impact of the pandemic on the demand for housing and shelter inflation. And I'm sure people are familiar, and I certainly know this from my own experience, just walking around our neighborhood. I mean, you saw signs, for sale signs, and you could walk the next day and already see that the house was in contract. So, I mean, there was just a very, a marked change in terms of the demand. But again, something that came out of the pandemic, a change in terms of people's preferences for the type of housing, where they wanted to live. Again, very strong changes in demand relative to a fixed supply. And again, those prices sort of went up, and that was exactly what you would anticipate.
Cliff, you have one?
We're hearing more about Bitcoin and cryptocurrencies. It's increasingly being used for cash. Recent Washington Post article said that 13% of Americans had bought or traded cryptocurrency in the past year, and that 36% of small and mid-sized American businesses are now accepting cryptocurrency. Is cryptocurrency having any impact on the stability of our economy? Are cryptocurrencies measured in any way on the consumer price index?
So digital currencies is something that's outside of my area. We have people at the Federal Reserve Bank of Cleveland who know much more about digital currencies. I have to admit that I have a very limited knowledge of Bitcoin and digital currencies and how they work. I would say, however, that the Federal Reserve has, in fact, begun a long-term study of the effect of Bitcoins and crypto and digital currencies and how it's going to impact the payment system. So this is something that's very much under investigation now within the Federal Reserve System. I think it's true for most other economies that they're also looking into, central banks, that they're also looking into the role that digital currency may play in terms of how they conduct policy and how that will impact the payment system. But speaking for myself, this is a little bit outside of my area that I sort of analyze. And so I think I'm just going to, for the moment, defer an answer to that question. Although, again, there are people at Cleveland and other central banks that are very much studying this, but that's just not something that I'm as knowledgeable about.
Well, thank you. Here's another question from Susan. An article in The Week magazine said that the federal projects inflation will be just 2.6% in 2022 and will gently slip down to the 2% range with little action from the Fed. But a journalist in the Financial Times said that the Fed will need to raise the rates that banks pay from the current near zero rate to 3% to 4% range to slow down the economy. What are your thoughts on this?
So I believe that Susan is referring to the Summary of Economic Projections, or what's referred to as the SEP. That is in fact showing in those projections that inflation is going to be moving down to the range. However, I believe it's also showing that they're anticipating the Fed raising interest rates. So I don't think that projection of lower inflation on the part of the FOMC and the FOMC participants, I don't think that projection for lower inflation is occurring without also several raises of interest rates taking place. So I think that the higher path for interest rates is part of what's feeding into their forecast for inflation moderating. And I'll go back again, that I believe that those individuals in the SEP have a higher path for the federal funds rate. They also are anticipating fiscal policy being less supportive than it has been, and they are anticipating these bottlenecks and supply chain disruptions to improve. So yes, there is a forecast for lower inflation, and as part of that, there is in fact a higher path for the federal funds rate. And in fact, Chair Powell and others have discussed the fact that they are in fact planning on, using both the federal funds rate, and then I haven't really gotten into it, but also changes in the balance sheet as tools that are going to be used to sort of begin to slow the pace of growth of aggregate demand. So yes, there is an anticipation of lower inflation, but I believe that that forecast is in conjunction with a higher path for the federal funds rate.
Okay.
Do you have a question, or otherwise I have one?
I'll go for it, Debbie, if you got one live.
I don't know any big corporations that just exist in the United States. So all of these companies have international profiles. Our markets are international. You guys and the feds do your little thing. Do you have counterparts in other countries that you talk with and coordinate with at all, or do you not pay any attention to what happens in these other countries?
So are you asking, do we talk to other central banks in other countries?
Yeah. Do you like kind of like talk and project together and see what you can do to kind of like, because what we do here affects over there, what they do there affects us. So is there some coordination between the federal banks of the world?
Yes, absolutely. And so there is a great deal of coordination among central banks in the world. And this takes a variety of forums. I mean, some of it is in the research area. For example, just going back again, the Federal Reserve of Cleveland hosts an annual inflation conference, and we co-host it with the European Central Bank. So we actually have an annual conference, an academic conference on inflation. We co-host that with the European Central Bank. That's just one example where, for example, researchers in different central banks sort of communicate with each other. But certainly, there are lots of policy forums where central bankers are meeting and talking with each other and discussing policy and action. So yes, there's a great deal of communication in a variety of forums across central banks in terms of this. So we do not conduct policy sort of in a vacuum here. I think that we recognize that we have to think about what other central banks are doing. It's a great deal of discussion with other central banks and central bankers talking to each other. So yes, there is a coordinated effort, and there certainly are channels of communication that are used.
And I suspect it's like the EU and Britain. But you talk to people like central banks of China or Russia also?
Yes, I mean there are discussions that take place with those banks too, with those central banks also. So I can't speak to the nature of those discussions, how frequent they happen to be, but again, there is certainly communication across. I mean, central banks are very aware of what other central banks are doing, and while there is some variation in terms of that, certainly central banks do talk to each other in terms of analyzing situations. I mean, certainly, just going back to the crisis that took place, I mean, there are established what are called swap lines where we can provide credit to other central banks that sort of in case they need funding and things along those lines. So there are in fact institutional arrangements that have been set up that sort of show this greater sort of international sort of coordination that are taking place. So it's very much recognizing the interlinkages that take place across the world and across countries.
That's kind of a relief, because you don't hear about that in the newspapers I read. So that's good. What?
Okay, we got one on CDs. Why are CDs only earning 1% or less? Not a good investment, nor an incentive to save money. Aren't U.S. savings bonds a better deal? I bought my first U.S. savings bond for $18.75 in the 60s with babysitting money at 50 cents an hour. It went to $25 after a number of years. What's the current rate my grandchildren can get if they save their money and buy a U.S. savings bond? Are savings bond a good investment for teenagers?
So again, I would prefer to avoid making any specific comments on financial investments. That's just not sort of where I want to comment. I'll just say a couple things. When you think about an investment, there's a risk-reward trade-off that takes place. And so where you decide to invest your money, and it is a lot of it has to do, well, it certainly has to do with what you're looking for, but obviously, if you're looking for a very safe investments are generally going to return less than riskier investments, because riskier investments, you need to be compensated more for them. One thing also to recognize too is that what you earn as far as an investment, it's not just the nominal return, it's also the real return that is taking out what inflation happens to be. So that also determines it. But where you want to invest depends very much on what your horizon happens to be, what your goal happens to be. There are decisions about how quickly, if in case you need the money, how quickly can you sell the asset and get that risk reward, all of that. So again, I prefer not to comment specifically on, what's a good investment versus a bad investment. I think that there are financial advisors who get paid a lot more money to answer those kind of questions. And so it would really be a question of consulting with a financial advisor to find what best suits what your particular needs happen to be.
And then I have a question about the gold standard. I didn't know the gold standard was still our standard, but it says, is the gold standard a safe investment for financial security, especially if inflation goes way up in 2022? How often does gold usually go up or down? Or is there any relationship between inflation and gold prices?
Okay, so let me comment this first of all. We're not on the gold standard anymore.
Yeah, I didn't think so. Right.
We're off the gold standard. I think the question is whether gold is a good investment these days. At least that would be my interpretation. And again, I will say that I don't want to give specific recommendations on investments. Again, gold is a commodity. Gold has in the past been used as a hedge for inflation. I mean, it certainly was very prevalent in the mid to late 70s, from what I remember, in terms of gold and silver and commodities like that. Whether gold these days is a good investment, again, I will defer to financial advisors and individuals in terms of making that decision. But we're not on the gold standard anymore. And again, the question of where to invest, again, I think is very much determined by the particular issues associated with the particular individual.
Here's a great comment for you, not a question. Valerie just wants to say that I think the reason you're getting so many off-topic questions is that your initial presentation was so excellent, it answered all the questions in the about current inflation. So bravo.
Well, thank you. I appreciate it. I do hope that the audience was. I hope I was able to clarify some questions. I hope it was clear. And again, I recognize that that inflation is on everyone's mind. I mean, I guess I'll just make one other comment too, which is, speaking personally, I do remember the inflation of the 70s. So I've experienced that. But I think that what's important is that there's a large segment, and I wanted to mention this, and of course I forgot because I'm so old, that there is a large segment of the population right now that is just not used to seeing inflation at these particular levels. And so certainly, while for some of us, the inflation readings right now, this notion of going back to the 70s, that stems from having lived through that particular experience. And inflation during the, sort of after the great financial crisis, I mean, if anything, the Federal Reserve was, if anything, worried about inflation running too low. I mean, that was our bigger concern in this case. So the high inflation readings that we're seeing right now, I certainly think that, there's two things that are going on. For some of us, we sort of remember what that was, or at least we sort of remember a decade of sort of high inflation readings. And so we remember that. But I do think there's a large segment of the population right now that hasn't really experienced this before, and it's a new phenomenon for them. And I think that they're trying to sort of understand and come to sort of you're suddenly placed in a very different environment where things happen to be. But again, I know I'm repeating myself, but I do hope that in terms of what's going on with inflation and why we're seeing those readings, I do hope that people come away from this, hopefully with understanding that there's just been this marked rotation in consumer spending out of services into goods. You combine that with sort of supply chain disruptions and bottlenecks in the goods sector. And I think that one graph I showed you, which showed you this rather dramatic rise in goods inflation, that is really driving a lot of the high inflation readings. And hopefully, when we see supply side issues sort of improve, you'll see that core goods inflation coming down, and then hopefully that'll be part of the story for moderation. I do apologize that I'm not a financial advisor and I don't have expertise in finance, but I would rather tell you that than somehow offer up advice and find out that it was poor advice. So But I understand why people are curious and are thinking about, where to think about investments these days. But really, that's outside of my area of expertise, and I prefer not to comment on that.
All right.
Yeah, is there any last thing you want to say? Because I think we're done with questions, so that we didn't get to say to us.
I'm sorry, was that for
Is there any,
me?
yeah, so I think the question's over because Wayne just appeared.
So
So
I
if there's
do.
any last little comment you want to
Yes,
make?
I do want to make one last comment, and I do want once again to go into self-promotion on this. But I really would, if your audience could really go, I would very much encourage your audience. Let me begin by first of all saying that I very much appreciate the opportunity to speak to you today. So thank you for that opportunity. The second is, please go to the Center for Inflation Research at the Cleveland Fed, and in particular, go to the Inflation 101 section. I think that there are resources and materials that are there that I think will be hopefully highly informative for you. We actually have some videos, animated videos to sort of get at these ideas of inflation. There's additional information on inflation, especially since so many people have questions about it, to go there. You can also subscribe. We put out a quarterly update to get people up to date in terms of things that we're doing there. So my last word is again, please when you get a chance, please go to the Center for Inflation Research, go to the Inflation 101 section. I hope you'll find it useful. And again, thank you for the opportunity to speak to you today.
Yeah, thank you.
Thank you, Dr. Rich, for an excellent forum on inflation. We truly appreciate your expertise, dedication to our community, and the economic research you do at the Federal Reserve Bank of Cleveland. It benefits all of us. Now I'd like to make a few announcements related to the forum. Next Sunday, February 13th, is the second Sunday of the month. And it's when we used to have community breakfast at Fellowship Hall, and we haven't been doing that with COVID. But we will be taking a quick break from forums, and we will not have a live forum next Sunday, but we invite you to look at YouTube videos of our previous forums. They're available at uucleveland.org, and you can choose from a great variety of speakers and subjects, including today's forum, which will be available to those of you who want to look at it again, and to those who were unable to attend this morning, will be able to watch it. 2 weeks from today, our forum topic is government mandated I'm sorry, but I just lost my screen. Laura?
2 weeks from today, our forum topics is government mandated pregnancy, Supreme Court or states' rights. We'll discuss pregnancy, gender equality, rights of women. Can equal rights exist along with religious beliefs and the right to life or not? These are important questions. Our speakers include Case Western Reserve Law Professor Dr. Hill and Lisa Riez, a lawyer at Boyer, Sater, Seymour, and Pease.
Quick reminder about future forums. Thank you, Cliff. I lost my screen there for a minute. If you're not already on our email reminder list and want to receive a reminder for future forums, please go to the chat box button and put your name and email address there, and we'll take care of it. Today's, as I mentioned, the forum has been recorded and will be available soon on the Unitarian website, uucleveland.org. We'd like to invite all of you to our dual virtual and in-person Unitarian service in the Shaker Heights building at 11 o'clock. Reverend Joe Donatone, our guest minister, will be discussing our 6th Unitarian principle: building community with peace, liberty, and justice for all. And the key word there is all. You can see the service live streamed on Facebook or YouTube. Go to uucleveland.org and click on the upper right-hand side of the website, and the YouTube link will take you directly to the 11 o'clock service. Again, we appreciate your support and look forward to seeing you 2 weeks from today for our forum on government-mandated pregnancy, Supreme Court, or states' rights. Thank you again for joining us.